Hi, my name is Harish Bihani. I'm a part of the equity investment team at ICICI Prudential AMC, where I manage the small cap fund and the long term equity fund, which is the ELSS funds. Today, we are going to discuss the small cap fund in details. Before we deliberate on the investment objective and strategy, let me share some key basic facts about the fund. The current size of our fund is around 3,500 crores. It is pertinent to note that the fund got recategorized as small cap fund in and around mid 2018, and accordingly our small cap fund has a performance history of around 4 years now. I have also been associated with the fund for a similar period. Now let me share the investment objective and investment strategy in details. Our investment objective in the small cap fund is to try and ensure we generate healthy risk adjusted returns over the market cycle. And the ideal aim is to generate return well ahead of the benchmark. Let's discuss our investment strategy in details. We divide the entire small cap universe into three buckets, bucket A to C. Bucket A are companies with quality compounding characteristics. Bucket B are companies which are normalcy candidates, which means current earnings are below normal now, but should normalize in the next 2 to 3 years. And bucket C are wealth destroyers, which is what we intend to avoid so as to make lower mistakes. Let me elaborate on each of these buckets in more details. Bucket A, as I said, are a group of companies that I call as quality compounders. These are companies with good and stable business model that are solving an important customer problem. These are run by competent management team. In these companies, there's good growth ahead. Here, earning potential can compound at decent double-digit CAGR over the next 3 to 5 years. These companies are typically market share gainers and they have good return on invested capital and the potential for higher return on invested capital in the coming next 3 to 5 years. And finally, we buy these companies at reasonable valuation in the context of growth and return on capital ahead. Moving on to bucket B, which are normalcy candidates. These are companies where current earnings are below normal. One of the reasons for this could be because of business cycle, which is currently subdued but should highly likely recover in the next few years. In this case, we are conscious to buy companies where earnings recovery are not dependent only on macro improvement. We focus on management teams that are working hard to ensure good business recovery. This could be led by new products introduction, higher geographical reach. Business now has a better efficiency and lower cost profile versus the previous cycle, which means lower profitability break-even point and higher profitability versus previous cycle. An important part is to buy these companies at a very low price to earnings or similar multiple based on companies' normalized earning power, which is 2 to 3 years out. We are looking for companies where earnings can potentially normalize in next 3 to 4 years at the maximum and at least double in that particular time frame. In this, we are also conscious that the average return on invested capital over cycle is higher than the cost of capital. Lastly, we buy companies in this particular bucket with strong balance sheet so that even if there are near-term P&L issues and even though business recovery could take a little longer, nonetheless, given that there are no balance sheet risks, these companies will survive and will finally thrive over the next 3 to 5 years. This is the segment where we make the maximum alpha for our investors, is what we have seen over the past 3 to 5 years. Moving on to bucket C, which are wealth destroyers, which is what we want to avoid at all cost. These are companies with weak balance sheet and or cash flow issues. These are companies with fragile business model that can't withstand macro risk like now. These are companies with deep turnaround stocks where there are both P&L issues and balance sheet problems. Maximum mistakes, according to our understanding, are made in this particular category. Management quality suspect is something again we are cognizant about. Finally, if you avoid bucket C, which is where you make maximum mistakes, a big part of the savings of the overall portfolio comes from here, and that is how you do well over the next 3 to 5 years. What we intend to do is to build a portfolio of companies with bucket A and bucket B and avoid bucket C companies. We intend to hold a portfolio where earnings will grow in high double-digit CAGR over the next 3 to 5 years. We think that by doing this consistently, the overall portfolio outcome should be decent over time. It is important to note that small cap funds are volatile during market extremes. For example, during macro shocks like now, the fund performance could be volatile due to lower stock liquidity. What do I mean by lower stock liquidity? Let me explain that in more details. Lower stock liquidity is defined by average traded volumes in a particular day, week, or month for a particular stock. During extreme market situations, like some days we are seeing now, a desperate seller will try and sell a particular small cap stock at any cost. And in that context, given the overall traded volume could be low, and there's a forced seller in the market who's keen to get out at any price, this leads to higher share price volatility, which leads to higher fund volatility. However, please keep in mind that this does not mean that the portfolio is risky or the company which has been volatile, that is risky. We define risk as the chance of permanent loss of capital. If a portfolio of stocks is purchased at the right value and held for the next 3 to 5 years, then the volatility risk, which we spoke about earlier, goes down substantially and the chance of permanent loss of capital is extremely low. More importantly, with a longer time frame, one gets to participate in high growth small cap companies that can grow significantly ahead of mid or large cap companies, given the base size of these companies, and help generate higher returns for the investors. Hence, we recommend investors invest in this particular fund with a minimum 3 to 5 years time horizon. Our top 3 holdings as per last published portfolio, which is as of May 2022, are Inox Leisure, KEI Industries, and Mahindra Lifespaces. The top theme that we are participating in this fund are discretionary consumption growth, manufacturing and construction boom, chemicals, pharma and API theme, IT and related theme, and the PLI theme. These are themes which we think are structural, which will remain for the next 3, 5, and 10 years. I hope this brief will help you take a better investment decision on our small cap fund. We thank you for placing your trust and confidence in our fund. We'll work hard to ensure that the fund achieve its objective of good risk-adjusted return over a market cycle. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.